Welcome back to Squawk on the Street. S&P snapping a 6-day win streak as the market rally loses some steam and yields definitely march a bit higher. Joining us here this morning at Post 9 is Venu Krishna, Barclays head of U.S. equity-linked strategies. We've been checking in with him pretty regularly. Thanks for coming back in, Venu.
Thank you.
Are bonds going to continue to keep us in check? Equities, that is?
Yeah, we certainly are in territory where you have to keep an eye. Historically, if you look at the levels of rates do matter a lot. So once we come closer to the 5% level, there's a perceptible pickup in negative correlation between the move in yields and equities. And that's because at that level, typically the market starts getting more concerned about inflation and currently, the impact of deficits and things like that. So I think given that, in the last few weeks we saw dramatic, derating and then a re-rating, it certainly matters because they've recovered a lot in terms of valuation.
One thing you've been looking at is the performance of companies that report earnings. Beating hasn't really gotten you much mileage, although missing has hurt, right?
Exactly.
And that tells you something about the market.
Yeah, it tells you a lot about the market is not very comfortable with the fact that companies are dealing with their guidance in many different ways with regard to tariffs. A bunch of them are taking a hit on margins, like in industrials, parts of pharmaceuticals, med tech, some part of tech hardware also. Some of them are increasing prices, again, part of industrials, for example. In terms of margin, it is more retail, which takes a hit. So companies are still grappling with all those issues, and given all the front-end loading you saw in recent weeks, I think the coming quarters are likely to be a little weaker compared to the strength we have seen the recent quarter.
Venu, it's Morgan. We have a dollar index that's back at lows of a month ago. We know that the dollar has weakened against major currencies in general in recent weeks. A lot of focus on the trade talks. You've got Group of 7 meeting in Banff. Focus there, too, and what that means for the trajectory of the dollar. We know that a stronger dollar has been a headwind to major companies' earnings. So is the flip side here that could actually be an unexpected or underappreciated tailwind?
Well, it can be a tailwind if you're more export-oriented, but remember, in the big scheme of things, the U.S. is a net importer rather than exporter. But the key question on, people talk a lot about the dollar, but in the work we have done suggests that equity markets generally ignore dollar-related changes on earnings, assuming it to be more or less a one-time hit. Should that change, then it's a different paradigm altogether. But what typically happens is if the dollar is strengthening and earnings are weakening, then the multiples change to offset that, right? So you would expect the reverse to happen if things are weakening. So in the big scheme of things, dollar directly on equity returns is not as impactful till we break critical thresholds, and I don't think we are there yet.
We've been hearing more takes that are pretty constructive on a lot of U.S. assets except for the dollar. Does that make sense?
Yeah, for example, when you think about U.S. equities, right? Let's talk about that. So the relative trade between Europe and U.S. probably has played out, right? And as the new administration is moving more towards growth-oriented policies away from the focus on immigration and tariffs, for example. So and if you look at just earnings, right? The magnitude of earnings strength you saw in Q1 has made everybody wake up and realize that at the core, the hard data is strong. I think the dilemma we face is that the soft data and the hard data have been diverging for quite some time. And this is a post-COVID phenomenon. And I would argue, generally, if you bet against the soft data, you were more right than wrong.
You were more right than wrong.
That's right.
To go with the surveys.
No, with the hard data.
To wait for the hard data,
exactly.
Yes.
The surveys have been more pessimistic.
Right.
So, for example, even right now, consumer sentiment is very low.
Yes.
Inflation expectations are very high. But the reality is, if you look at the consumption in general, it's weakened a little bit, but it's still pretty robust. Services is strong, and goods has sort of weakened a little bit. So the point is that post-COVID, one interesting thing is that a weaker survey data has not necessarily translated into weaker hard data.
Yeah, they've been consistent head fakes, some argue, given their strange methodologies. Venu, hurry back. Good to see you. Thanks for coming in. Venu.